Oh, that sucks. How do we get to where it's not messing up with that? I don't know if that's gonna work.
I muted mine.
Oh, that's a good idea. But
You gotta mute yours.
I know, but mute what? Which one?
Mute your microphone on your phone.
Okay, but if I mute my microphone, is that gonna still work though? Can you see? I can't hear you. Can you see me here? I can hear you on here, but I can't. I want to be able to hear you on my phone or my desktop though. Sorry guys, if you guys are watching, we're trying to figure this out. We're trying to go live on both Instagram and Facebook at the same time. So some technical difficulties, but we'll get this figured out. So Brian, did you mute yourself on your phone or did you mute yourself on your desktop? Okay, so I could only hear you on my phone, not on my screen. There we go. Okay, cool. All right, so now I can hear on my because the one that's on our screen through StreamYard, that's going to YouTube, Facebook, all several different Facebook channels and stuff like that. So, okay, so I think we got it. Hopefully you guys that are on Instagram can see us or hear us. You definitely can see us, but hopefully you can hear us as well. Put this over here, so hopefully there's not interaction. All right, so what I love about live stuff is that you have this crap that happens and trying to figure things out. But I appreciate you guys all being patient with us as we get this thing going. I'm Nazar with Provident Real Estate, and with me is Brian Decker from Loan Depot. So I appreciate you being here with me today. And the reason I wanted to kind of talk with you today is obviously, my sphere might not know you, or a lot of them don't know you. So I wanted to kind of bring you. So tell us a little bit more about who you are, and then we'll get into some fun questions. So
yeah, absolutely. My name is Brian Decker. Been in the mortgage industry now for about 16 years. I was originally an accountant right out of college, and decided to get into the mortgage game back in 2003. And I spent the first about 6 or 7 years of my career, before the big housing crash. And I was one of the few people that decided during the last housing crash that started in 2008, to try to bunker down. And I went into the crash as kind of an unknown. And by the time the crash was done, I was fortunate enough to be, consistently ranked every year from here on out as one of the top 10 loan officers in the country. That I do, I now own a company called Modern Lending, that, we do roughly in the neighborhood of, probably should do about 600 to 800 million this year. We typically are, we work with pretty much all the biggest real estate agents on that side, as well as I travel quite a bit and do a lot of public speaking and podcasts. I'm a student of the game. I've, got my master's degree and did economics. And so that's kind of where a lot of my focus has always been, is kind of actually not just studying, what's going on, but why things are going on, so we can kind of have a predicted model of how to handle this craziness that we're going through.
Yeah, Brian, there's somebody that says that they can't hear us. I don't know if that's true for everybody or if it's just one person that's having that issue. You guys, if you guys can hear or seeing this right now and you can't hear us, can you just give us a little quick shout out? If you can hear us or not, give us either a little heart or put in the comments below so we can see that. I don't know why we're okay. Perfect, cool. So someone else can. So just Jason, if you're, yeah, it seems like everybody else can hear us, so we're good to go. All right, so let's get right into it. So a lot of people have a lot of fear and anxiety with this whole coronavirus thing going on. Even before we got into this whole coronavirus thing, obviously started hearing stuff in January, February got a little bit more real, and then of course, March hit the crap hit the fan. And so in the real estate market, things are just on fire, getting into that point. We had the best first quarter than we had ever had in a very, very long time. And so it was a very bullish seller's market, super competitive, multiple offers. And of course, that kind of came to hold for a little bit. So tell me from your side of things, as far as the loan side of things, how did the year begin, and where are we at now? And then where do you see yourselves? Where do you see us in the loan aspect of it this year, and then in the next 2-3 years?
Yeah, absolutely. I mean, one of the things that people have to understand is we were seeing a fantastic first quarter. We saw a fantastic fourth quarter. Year over year, when we started out this first quarter, interest rates started out this first quarter, in the mid threes, the high threes, which was almost 1% lower than where we were just 9 or 10 months prior. So January, I mean, year over year, January pre-approvals were up about 20%. February, people have to understand from a purchase standpoint, February is a 13-year high in purchase sales here locally in the Southern California market. We had 2 households being created for every 1 house that was coming onto the market on supply side. So we had extreme demand. We obviously had, low supply on the market, extreme cost of, financing being extremely, extremely low. Things were doing absolutely fantastic. And then obviously as the coronavirus kind of made its way from a global, kind of something that was outside of us to here locally, we saw interest rates even further improve here on our side of the world. And then that obviously led to new historical interest rates being done. And then obviously the big move that really kind of shook the world was the Fed opening up their big mouth and deciding that, they were going to tell everybody, every of the 128 million households in the United States that are homeowners, hey, you know what? If you've been potentially affected by COVID, reach out to your mortgage company and why don't you start and get a forbearance agreement? They basically, took every bank's checkbook and started writing checks without putting money in their bank account first. And that's really what's kind of currently right now shocked our market. And so what people have to understand is what we're seeing right now is a very short-term something, and it's been completely caused by the Fed. So what the Fed came out and did, and so everybody understands why forbearance is so dangerous, is they made no ability that individuals actually had to document their hardship. They just said, hey, if you got a mortgage, attest to something that you've had a hardship, and you don't have to worry about making your mortgage payments for whatever, 3 months, 6 months, up to 12 months. Well, the problem that everybody needs to realize is those mortgage companies. So let's say I am Chase Bank and you, Nazar, are my mortgage client, and you call up to me and we're like, hey, you know what, Chase, I'm going to test something and say I don't got to make my mortgage payment. Well, I, as Chase Bank, I still have those principal and interest payments on the loan that I got to forward to the actual investors that are securitizing and holding that loan. So even as me as Chase, even though I'm just collecting your payments, I'm not the one that actually is the one that actually funded your loan and securitized it. So Chase now and all these banks, for every $1 billion in servicing that it goes into forbearance, they're writing $49 million a month in cash flow payment. So just to give you guys a rough ballpark idea, even if 1% of all the mortgage loans in the United States go into forbearance, you're roughly looking at, each bank having to come up with somewhere around $200 million a month in cash flow payments, and that's at 1%. Well, the servicers we've been talking to now, they're saying it's already at 10%. So do the math. 10% of people are entering into forbearance. So what's happened is we've now come into basically a situation where lenders, all banks across the country, are like, holy crud, we got to tighten these guidelines down and hunker down in the interim, because we got to stop this bleeding. Because even though FHA loans and VA loans, Ginnie Mae came out and said, hey guys, banks, we're going to help you. We're going to put some money in your bank. We're going to help you bear through this. And so now the FHA and VA market is a very liquid market. So people needing FHA financing and VA financing, yeah, credit did tighten, and rightfully so during this time, because there are people that, if the credit score is below 640, and they haven't shown that they've been able to maintain their, paying their bills on time, they're wanting just stuff right down the fairway right now, which, 640 and above credit score is not like you're asking somebody for an 800 credit score. It's very flexible. But what happened is, on the conventional side and the jumbo side, there has been absolutely no assistance by the federal government. The actual Mark Calabria, who runs Fannie Mae and Freddie Mac, is basically giving the big middle finger to every mortgage bank and every bank out there and says, you guys deal with it. and the problem is they didn't ask for this. They didn't ask for this pandemic. Weren't the ones that went and told all these consumers. And so because of that, now they're running out of liquidity. And so they're having to tighten that box on what they can lend, making sure that anybody that they're lending to has zero chance of entering into forbearance over the first 6 months of that loan. So that's kind of the short term that we're seeing. And that is only going to be something for the next 60 days, because it has already been the biggest upheaval in our industry at Mark Calabria and what he is basically doing to not help Fannie Mae and not help banks do this. And so once that gets put into place, and his hand is being forced by, there's so much coming through Congress and Senate right now. So once that comes out, we're going to see a much more relaxed environment. And so in the short term, yes, on the conventional side of things and jumbo side of things, it is more difficult to get financing. There is no way about it. But help is on the way. They've already dealt with mortgage crises before. And mind you, this is not a crisis of bad loans. This is a pandemic that stopped our economy. And so in the short next 60 days, things are tight. Things are tight. There isn't riskier stuff being done. After 60 days happens, be prepared to hold on to your seats. I literally just got off a conference call before this with basically the who's who in our industry. It's about 2,500 of us that actually got on it. And verbatim, they just said between now and 2023, they expect, interest rates to just continue to stay at historic lows or even get lower. So, I mean, we can expect their Fannie Mae, Freddie Mac forecast is 30-year fixed interest rate loans below 3% next year, and to stay there for a long time. So be prepared for a crazy ride. Both 5 trillion homeowners are going to be having to seek of a benefit to refinance over the next 12 months. So that's 5 trillion people. Okay, that's 2.5 times greater than the greatest refinance bubble we've ever seen in this entire housing market. What happens when house prices get the support of extremely low financing? It's a very nice market, So that's kind of just a little touch on it.
So what I'm hearing you say, Brian, and obviously you spoke a lot of things, a lot of good content, is that if you are, because I know you've said this, but I don't know if my sphere have heard this, that if you're in a position where you can make your monthly mortgage payment, and for that matter, if you're renting, make your rental payment, don't screw up your credit. Don't put yourself in a position where you're going to get, dinged in the future. Make that payment, right?
Yeah.
Stimulus package, whatever you have, make that payment if you can afford it. If you can't, if you absolutely can't, if it's between making a payment and food on your table, I hear that. Talk to the servicer and work things out. But if you can't, don't just say, oh, this is one of those, hey, really cool things. I'm going to push my my payment for 3-4 months, get through all this coronavirus stuff, and then I'll get back into it. That's not how it works. If that's been painted that way, do not follow suit. Don't go down that hole or go down that road.
It's exactly. And really key on that. And what people really have to understand is this was put into place to help individuals. But first off, before they came out and jacked up unemployment benefits, mind you, too, unemployment benefits now are $1,000 a week. Okay. So they are now substantially higher. They purposely did that to keep people paying their payments. Right. So on top of that, now the forbearance is not a freebie. This is not free money. What happens is technically speaking, the banks at the end of that period of time, so after, let's say it's a 6-month forbearance, they actually in this bill have the right with the CARE Act to make all 6 of those payments due immediately at that time. And if they don't, then you're in a position of being in default of your forbearance, and you can do a workout, and nobody can purchase a new home or refinance their home if they're in forbearance. And so the interest is not going away. So use it as use it how you would use unemployment. Nobody quits their job to go on unemployment. You lose your job and then are forced to go on unemployment. Treat this the same way, in essence.
I love that. So you don't lose your job to go on unemployment to collect that check. You do it because you lost your job. So don't go on forbearance unless you absolutely freaking need to do that. So really good advice. So you talked about the market. You feel like there's going to be a huge surge of people refinancing. Now, I'm going to ask that same thing. There's a lot of people. I think what I heard the national average is that there's 30% or 35% of people have a tremendous amount of equity, and I think even like 50% or more have more than 25% equity or 30% equity, and then there's 35% of people have no debt on their mortgage, or they don't have a debt on their property. So there's a lot of equity built in people's homes. You're saying that because rates are so low, people are going to refinance. I'm assuming you're saying that because you're going to refinance and can't pull money out just to for a rainy day, or because they want that cash in their hand. Do you think that's pretty a risky move as well? Because back in 6, 7, 8, people were using their equity in their homes as piggy banks, and obviously we know where that got us. So would your advice be for them to refinance and cash out? What are your thoughts?
Yeah, so a couple of different things. So you're almost exactly right. So to give you guys an idea, the average of the 128 million households that are in the United States, the average loan to value, meaning the loan amount compared to the value of that home, is 53%. Okay, 53%. So you have almost exactly right on. You have 30% of people in America that have no mortgage on their home. Okay. And so those that do have an actual mortgage on their home, their loan to value is under 70%. It's the lowest ever been recorded in United States history. So people are sitting on more equity than ever. And also, too, on top of that, people are obviously sitting at very low rates. Now, what happened, I was involved in the mortgage crisis. What happened at that time is people they didn't give themselves a buffer. They were able to take out 100% of the value of their home between first and seconds. They were able to go to 90% loan to value on their home. They just used their house as an absolute piggy bank. Now, when it comes to both the refinance standpoint, so I am a very firm believer that when money is very, very cheap and you do not have a safety net, you do not have 6 to 12 months of reserves in your bank, and you are sitting on that equity, you should definitely evaluate not taking the whole equity out. But if your house is worth $600,000 and you only owe $300,000, interest rates are so low right now, you can literally borrow $50,000 and very likely have no change in your monthly payment. Take that $50,000, stick it away in a rainy day fund for, if this ends up being a little bit more effective for you, and you're going to be, and plus two, more importantly, with the cost of funds being so cheap, things go on sale. And in my personal belief, we are going to see a 5 to 8% price drop in the housing market in the short term. And it's not because there's a lack of people wanting to buy. You just had anybody with less than a 640 credit score lose the ability to finance. You just had anybody that was self-employed and couldn't document their income on tax returns, needing to use programs like a bank statement program. Those are gone. And then you also had all of your big banks, Chase Bank, Wells Fargo, Citi, Bank of America, all now requiring a 700 credit score and 20% down. Now, independent mortgage bankers like us, we still have much lower down payment programs, but that doesn't mean, everybody's still going to see that. So you're getting those short term, you're having a dramatic decline in the amount of people that can actually go out there and buy a home right now because of the limited finance opportunities. And then a lot of people obviously were put on furlough or they're just uncertain. So we are going to see in the short term, my personal belief, a decline to 5 to 10% in the price points of houses, depending on the market and depending on the purchase price. But it is very short-lived. On the call I just got off of, they are extremely bullish and this is multiple from both sides, Democrat and Republican, extremely bullish on the entire real estate market all the way through 2025. Extremely bullish. They all feel that we're going to see about a 6-month things go on sale. Why this kind of shakes out, very similar to kind of how we saw in Hurricane Harvey, because people have to understand a pandemic is a sudden hit to us. It is a sudden, forceful act of God that stops our economy. This is not, hey, we were giving bad mortgage loans and real estate was faltering and now it caused the economy to go into recession. No, the economy was halted and is forcing house prices to go down because of these restriction areas. It's a very different concept. And once that economy opens back up, you are going to see people get back into the market and they are going to be enticed because rents are not going down and interest rates are dropping. interest rates in the high twos make a $400,000 home $400 to $500 a month less expensive than just it was 18 months ago. So I definitely see in the short term we have an uphill battle. We definitely do. And for people that do have the ability and job stability and money in the bank, it is a great time over the next 6 months to go shopping and to find stuff on sale and to find people and to pick up something. But with ultra low interest rates that are going to be going through and a large part of the economy that is going to be right back at work, yeah, we're going to see the hospitality and, entertainment sectors take a little bit of a hit. But I truly believe that, 7 years from now, 6 years from now, you're going to look back and it's going to be one of those times where people are like, man, I wish I would have bought something during that second half of 2020 when stuff went on sale, because demand's not going away. People aren't stopping getting married. People aren't stopping getting divorced. People aren't stopping having kids. Those things aren't stopping right now. And those are forming household creations. And we're not getting enough new houses hitting the market. It's reduced supply. People aren't going to be moving right now because of COVID. So you have a lower supply on the market. So, that entry level price point, in those markets, they're going to show real resilience. And we're going to see, in my personal opinion, a really nice kind of up movement in price in the next, call it year from now. I think we have a 6 month not fun, but super strong after that. Yeah,
I've seen like this, X or a curve where it's going to go down just real quick and then it's going to go skyrocket up. Blake was asking, do you feel it's going to be we're going to get to a buyer's market? And I personally, my personal thoughts as a broker is that, I don't know if you're going to see a buyer's market just because there's such low inventory right now. I mean, normal supply and demand, there's less than a 2 month supply of inventory in most places that I'm aware of. So even though there's less buyers that are out there, aggressively buying, even though there's tons of them still, there's just less homes that are on the market as well. So when both those things get released, you're going to have people that are going to put their home on the market and the buyers that are buying. So
yeah, I agree. Yeah, Chris Whalen and Dan Stevens, probably the two most authorities in the actual housing and space. Both one of them out in New York, and then Dan Stevens is just a brilliant mind. He was on the last call, and they both. They've called, these guys are in their 60s. They've both called it every time. And they said, here's the problem is you have less buyers that are out there. Yes, you do, because financing was pulled away, but you have equally as number less sellers pulled off the market as well, because they're not being able to put their houses on the market. They're not able to move. So you have that. So for every buyer, 3 buyers that you go down, okay, you lose 3 buyers where you're losing 3 or 4 sellers at the same time. Yeah. And so you're still having that shortage, and we're not building homes right now. There is a major problem because the cost to construct homes right now, due to the cost of labor increasing so dramatically over the last years, we have an extreme shortage of houses being built over the last 5 years. And we have more houses being created than ever. And the largest growing age range in the United States right now is centurions. So meaning people living to over 100 years old are the fastest growing segment. So more people are being born than people are dying because people are living longer. So you're having more and more households being created to a 2x to household. It's crazy. And so, I'm a firm believer. I do see a small price drop, but we're just going from, I'm seeing, at least in markets where the median house price in the area, you're seeing going from 6 or 7 offers to maybe 2 offers, but there's still offers. In 2 offers coming in is still going to get you the list price. 6 offers is just going to get you over list. You know what I mean?
Yeah, we actually covered 2 markets, Southern California and Southern Utah. And Southern Utah, nothing has slowed down. Yeah. There's been no dent in any type of activity. Things are just going bullish and strong, multiple offers, home selling quickly. So yeah, there's, all of it is just in our heads, right? Yeah. And to some degree, obviously, limitations of being able to go out of town or go outside and do our normal day-to-day activities. But man, there's a lot of people that just are doing their thing. Let's see here. So someone posted that they see the commercial rates at 2.5% interest rate for 15 years. Do you think it's advisable for this at this time? So I'm seeing commercial rates at 2.5% rates at 15 years. Would you do it?
So, I honestly haven't seen commercial loan rates that low. The commercial market's pretty low. I mean, I'm assuming he means seeing on a commercial that rates are that low is what I'm assuming.
Oh,
yeah.
Oh, yeah.
15-year fix are fantastic. I mean, honestly, that's our product that we're locking more. Like, it's funny, like our office normally handles, and I'll be like, pre-approvals in our office week over week are down 80% this week, but refinances in the office, they're up like 300% this week over last week, because people are finally, I think, realizing like there was some liquidity put into the market, so rates are starting to behave a little better. The 15-year fix is incredible right now. I mean, you can get like a 15-year fix paying a point at like 2.5% interest rate. So for anybody that's planning on keeping, and that's what we're going to see the shift to. There's going to be a big mortgage shift right now, kind of going back to when I got in the industry, where paying points is going to be a thing of normalcy, because of one, they've now really tightened the yields. So before this, call it a year ago, it was very common to take a higher interest rate and get lender credits. Well, Fannie, Freddie, and Ginnie said no more of that, because what happens with that is people take this high interest rate and then 6 months later they refinance that loan. And when you churn paper like that, it's massive losses to Fannie, Freddie, and servicers. So they've stopped that, because that will put our mortgage industry out. So now we're seeing a 1 point cost can get you a 0.5% lower interest rate. So you keep that loan for 3 years, and I mean, you're sitting pretty. So it is, truthfully, the only thing is our bad time to refinance right now. It is a very bad time to refinance if you are looking to go ahead and do a jumbo loan. The jumbo loan market is gone right now, because the jumbo loan market is funded by securitizing on Wall Street, and Wall Street's just trying to sustain their losses on these forbearances. The last thing they want to do is go put more money on the market that they're not getting secured by the Fed. So the jumbo market is an illiquid market. Right now, I was even going through my own refinance at Chase on the jumbo side, on my own personal loan, and Chase stopped it. And I mean, I've been a private client with them for a long time, and they stopped it. They said, sorry, and they priced themselves out. So they are still doing purchases for like some banks and credit unions, like Liant Credit Union is still doing stuff, but big banks have really pulled that back because of this forbearance issue. It's crippling them. So you will see, if you do have a jumbo loan, do not refinance right now. And if you are trying to buy in a higher end market, if you're trying to, let's say, buy $1 million plus in a lot of those markets, it could be a really good time to buy in those markets, because a lot of the buyer pool was really shrunk because of the financing. Really, pretty much anything less than 20% down is completely gone. And really only a couple of the big banks are even still lending, and they are only really still lending to people that are keeping a good amount of money in the bank with them. And so it's a joke. I was on a podcast before this, and they said there's two things that's a great thing to buy right now is Bentleys, Rolls Royces, Ferraris, and multi-million-dollar homes, because that's what's going on sale right now. Like, because not a lot of people are able to kind of still pull those off in those things. So I think it's I think those are going to be the most susceptible, is the higher end price points on a lot of those homes. I mean, it just came out today that New York City's homes of over 4 million have already dropped 15% since the beginning of the year, which is, so.
Yeah, it's just a smaller buyer pool, and that's going to get even shrunk, right, from all the chaos right now. So if you were to give advice to people that are out there right now, what would you say would be the top smartest 3 moves you would make?
Yeah, you talking just in like a general sense, as far as or in the mortgage or real estate? Because
the people that don't know you don't realize that you're a very smart guy. You're young, and you've made a lot of good financial decisions and choices. I mean, I remember Brian and I spoke, it was like a month ago, where you talked about, I saw the cruise line stopping, and I realized that there's gonna be less travel, and therefore I shorted some oil stock and made some really good money that way, which made me get excited about going back into the stock market, because I had it for a very long time. So I made some really good money from that. So, I mean, obviously
absolutely. Yeah, of course. So I love stock stuff. So a couple different things. One of the things, first off, I am not a stockbroker, but I do study the markets a lot. So a couple things. I personally, big belief right now, I think shorting the stock market is a great idea right now. I think a couple things that people need to look at, 2 kind of EFTs specifically, is MZZ and SDS. That's MZZ as in Mary, Zebra, and then SDS, which is, Sam, David, Sam. These are EFTs that short the S&P 500. And the reason for that is because if you looked at any trend or any market that we've ever seen, they have something that's called a dead cat bounce. And so think about it like this. Okay, what ends up happening is if you drop a dead cat or dead animal off your roof, what happens? It falls, it hits the concrete, it bounces up, and then it comes back down. So we are seeing what everybody believes is a dead cat bounce right now. That people, we hit a bottom, we're bouncing back up, we're having extreme optimism, but no earnings reports have ever come out since COVID. So we are going to see massive losses, billions and billions of dollars in losses on these companies. And the PPP program that came out, the payroll protection program that came out, ran out of funds in less than a week. I don't know anybody that got any money. So we are going to still see a lot of drop in the market. So one big piece of advice is short the stock market on that. The second thing I would recommend on S&P 500 specifically, the second piece of advice I'd give you is the demand for oil is extremely depressed right now. You got oil trading at about $17 a barrel. There is absolutely 100% certainty that the price of oil will be going back up. So now whether that's going to be going back up in 3 months, 6 months, 12 months, but right now we have the world shut down. So we have a major surplus of oil out there, which has just crushed the supply of oil at $17 a barrel. So I think that, looking at a long oil position is a great decision but it's a long-term play. Figure you're going to invest that money. You may lose 10 to 20% potentially as a downside risk in the short term, but you don't realize it until you sell out of it. But I am extremely bullish on oil's rebound over the next 3 years. People are going to go traveling more once this gets, past us. They are cooped up. They're going to drive their cars more. We have all this pent-up demand. And I see oil bouncing back to $30 a barrel and by next summer in 2021. So I think that's a really, really good piece of advice. It's to look on that one. And then the third piece of advice, go ahead. Do you have a question?
I'll let you finish first.
Okay. And then the third thing I was going to say specifically to do is right now, if you are in a position that you are a homeowner and you are sitting on a bunch of equity in your house and you do have a job and you have not been affected by COVID, do not let that equity sit there, because just remember, every day in a recession that we are in, we are one day closer to a boom. And every boom that we are in, we are one day closer to a recession. So right now we're being forced into this. So you should be a buyer on some of the most pessimistic days out there. That's where money's made. The greatest companies and greatest investments are made when everybody else is panicking around you. Long-term plays and long-term investments are always going to come out in fruition. And so what you should do is, if you're sitting on a massive amount of equity in your home, don't just let it sit there. It's not doing anything for you. Like, don't rip it all out, but have a safe buffer. If you only own 50% of what your house is worth, go pull out, 10% of the value of your home or 15% of the value of your home. Keep your loan to value under 30%, or under 70%. So use some of that equity, put it in something, and make some strategic buys in the market, whether that is, buying commodities like oil, whether it's shorting the S&P 500, whether that's putting cash on the side to start that side business right now, why things are a lot cheaper to be able to advertise on Facebook or advertise into Instagram. Use this as an opportunity to come out strong. Don't sit on the sidelines like everybody else does all the time. Yeah, it's risky, but you know what? Like, you have to take risks to make big money, And so those are kind of the three things I'd hit specifically.
Okay. I appreciate all that. That's a lot of, again, really good stuff.
Yeah.
People will go back and re-listen to this if they need to. I was talking to a friend of mine, and he was saying, Nazar, look for the opportunities that are out there that this is going to create. He said, listen, when this is, let's imagine let's hallucinate for a second that tomorrow the government says, all right, you guys, this has been fun. We realized that we were being a little bit more, aggressive in our approach than we had before. Everything's fantastic. Everyone go back to work. How do you see that playing out? How do you see that playing out? Because I think there's going to be a lot of people are traumatized based on, shaking hands and being in the same space. We as Americans were already, we liked our personal space, unlike, a lot of our European or Asian counterparts. So how do you see that working? And then based on these new social norms that are going to go into play, how does that affect, going on a cruise or, going to a sporting event, these types of things? And then how does that play into the overall market? What are your thoughts on all that?
Yeah, so I'm really not bullish on the entertainment industry and travel industry. I think you're exactly right. I think people are going to they're going to keep a very close circle of friends. And I think that, like, even with my family and stuff, like, we've kept like two families that live in our neighborhood that we see. We don't see anybody but each other. And so we get to see and hang out. And so I think we're going to see a lot of that, kind of a lot of really niche-y, kind of like pack animal kind of little congregations of people.
This is my group, my special group.
Yeah, like, this is my group. I think people now, the younger generation, I think the under 30s are going to go right back to normal. They're going to go right to spring break again. They're going to go right to bars again. They're going to go right to concerts again. They're going to have I live for today and not tomorrow attitude. And I think that you're going to see in that sector, they're not really going to care, because they just said, I'm young, I'm healthy. The chances of this really affecting me, I don't really care. So I'm willing to take the risk. So I think in the younger generations, you're going to really see a lot of that being very heavily segregated to those types of groups. I 100% the people that are older, people that are, in their late 50s and older, I see them, kind of being very concerned about going on cruises and very concerned about traveling. I think that grocery stores will still, segment things based on age, kind of going, reverting back to how back during the 40s, 50s, and 60s, it was like a racial segregation. I think we're going to see an age segregation, and for the positive, not a negative, but for the positive, like elderly people, like how you have the early bird special in restaurants, you'll have senior hour that they can go and be, I see a lot of those things taking place.
Hold on. Are you saying that this is going to be like that way in a year from now, in 6 months from now?
I think to be honest, I think it's going to stay. I think people are going to do that in a lot of environments through the end of the year. I think I really believe it. I really believe people care more about their health than anything else. If we've learned something about this, they care about their health more than anything else. And I think too, there's a lot of animosity. There's a lot of animosity out there, and more that gets out there. And I know yesterday myself, I was studying the trade bill. So I'm in a mastermind group called the Survivors Group, and it's 15 guys that are all uber successful, uber wealthy. And then I just knew them. So I kind of got in with these guys, and these guys are like brilliant minds. And they were bringing to light the fact of, Barry Habib brought to light the fact of what's crazy is, we all remember the trade deal. We had the trade war that was going on with China that started last year with the tariffs and everything else. Well, what ended up happening is, we all remember the trade deal was signed, and that trade deal got signed. And when the trade deal got signed, the stock market went up and it rallied. We saw there was like a renewing of, we're going to keep more jobs over here. Well, what people don't realize, in that trade deal that was signed, okay, it gave China an out on that trade deal under two things. One, an act of God, and two, a pandemic. Do you know what happened the week after the trade deal was signed? COVID got announced to the world, okay? Well, do you know what was obviously determined that knew about COVID? The World Health Organization found out that, obviously China kept COVID under wraps for 5 weeks before it came out to the world. So there is going to be some major, this is going to be really long-standing. Like, there's going to be some major issues between the United States and China for a really, really, really long time because of that. The amount of lives that are lost, the damage that it was done to our economy, and more importantly, it's just coming into light now that, imagine if me and you were boys and all of a sudden we sign a marketing share agreement, and I'm like, hey, by the way, I can break this agreement if there's a pandemic that comes out. And I just found out, because I just got back from China, but there's a pandemic coming over here. Me and you ain't going to be boys no more,
Yeah, it's interesting, right? There's so much. If we start getting political, then that's a Pandora's box. I don't care if I want to.
Exactly.
But I think there's still, it's so new. There's so many things going on though, but I guess I'm trying to be as optimistic as I possibly can, and looking for the opportunities that this is presenting as well, outside of the real estate, mortgage space. You know what I mean? Like, what can we do? What businesses can be begun? looking into the trends of how things are going to be like in the future, do you have any suggestions on people? Because there's lots of people that are not working right now, that don't have their jobs, that might think, gosh, what should I do? What type of business should I begin? Or maybe they need to quickly pivot from what they were doing now to what they can do. Any thoughts on that? And then, of course, Sharon's asking, is it a good time to buy? Absolutely, based on what both Brian was saying and I am saying, that right now you're getting a screaming deal. If you were in the market to buy a house, jump on the bandwagon now to get something. Or there's no bandwagon. Jump in, get into something now. Get those interest rates as low as possible before the floodgates open. But going back to what I just said, again, what are your thoughts? Do you see any small opportunity business that could potentially scale in the future? Hand sanitizers. I mean, we just bought 100 hand sanitizers to hand out to people. Normally hand sanitizers are like $1.10 for an ounce and a half or 2 ounces. We paid $3.75 a pop. Yeah. I mean, talk about price gouging, dang it. So you see those opportunities, like anything? Yeah. What do you think?
I think one, we're going to see a lot of digital interactions, right? So things, for example, like Zoom, right? Zoom meeting is blown up. Like I loaded up on Zoom stock as soon as COVID hit, bought it at like $90 a share and sold it out at like $155, $160 a share. And so I think we're going to see a lot of those types of social norms come into place, a lot more of that. I think we're going to see in the fitness industry specifically, we've already kind of seen a move to like Peloton, right? Peloton and those types of things are going to be better than ever because people at the gym are going to be people sweat at the gym. The gym is probably, of all the places, kind of the nastiest place where I think they're going to have a hard time. So I think we're going to see a lot of gyms struggle for a while. And I see a lot of opportunity kind of in the health and fitness space. I think with people being really concerned over their immune systems and things of that nature, I think there's going to be a lot of great opportunities in just different meal delivery kind of things. I think in a lot of healthcare, I could see somebody doing like a subscription service for like the COVID wellness pack, right? Like, they send you certain immunities every single month, an IV service that comes and keeps your immune system as high as possible. I see different healthcare things and moving into like that Peloton space with competitions in there. I also really see a lot of move to actually companies themselves going virtual and giving people the ability to work at home and all the different types of services that would come along with those types of things. Because I think if one thing people are going to learn, they're going to be like, wait, I'm going back to work. Do I really need this $25,000 a month brick and mortar rent? Or can I maybe downsize on my rent side? So maybe like the WeWorks, kind of more collaborative spaces that are coming into play that are on the smaller set. I see a lot of things kind of going specifically in that direction.
Yeah, that's interesting, right? Because, imagine if that was the new norm, how things would radically change for, how we do things. I mean, I've been told that any type of a pandemic, any type of a very huge, quick shift and change, creates a lot of new businesses, and it also squashes and kills a lot of how things were and the businesses associated with it.
Oh yeah, I think plumbers. My uncle owns a plumbing business, and they are swamped. All right, I think home filtration systems. People are going to be spending. I think a lot of times too, people are going to spend a lot more time in their homes. Yeah. Obviously now, so people are going to be putting in home theaters. I mean, doing all the different types of things to make being at home more like a vacation. If they're going to be doing that, I see a lot of that happening.
I mean, don't get me wrong. I love my house. I have a beautiful home, but holy crap, I am, as an extrovert, going bananas.
Oh, man.
Just going nuts. And so maybe I'm going to be one of those people that's not the norm. And as soon as this is all over, just go anywhere I possibly can. But I hear you that there's definitely a lot of reservation, a lot of concern. People are going to be peeking out of their houses, and it's going to be slowly. But I'm hoping, maybe you're right, but I'm hoping that we get to the point where we completely forget about the past.
Oh yeah, and human beings are that way. I think it's going to be something going to be that way until we get a vaccine. I think the vaccine is what's gonna give people that mental state. Unfortunately, I think that's what's going to be. We're gonna not feel fully safe until we have a vaccine. I'm not a hypochondriac at all. Like I don't really be concerned about that. I only kind of watch what I do because I spend a lot of time around my grandmother and my mother, and my grandma's in her 80s. And so I would feel very guilty being asymptomatic and bringing something around them. So that's kind of where my caution comes in, not really for my own health or safety as far as that goes. But I think people are going to be they're either going to have to choose to be that way and be like not be around those people in their life until a vaccine comes in, or two, they're going to have to not do the other things they want to do if they're going to be taking care and being around people that are susceptible to that in life. And once a vaccine comes out, world's going to go bananas and it's going to be one heck of a party.
Hopefully. It all depends on how that vaccine comes out and, how it's administered. And so there's still a lot of variables out there, but I have expectations that things will move in the right direction. But man, this has definitely been a curveball for 2020. That's for sure.
Yeah. It's good though. It gave people the recession they wanted, man. People have been talking recession. Gave them the recession, and maybe they'll shut up for a while now,
Well, yeah, I mean, and who knows? Like, I know the big reports that I've seen, they say recession doesn't mean housing crisis. Those are two separate things, which could potentially be true. But it's definitely interesting to see what the rest of this year is going to carry out to. Now, a lot of people are saying as soon as this thing is over, there's going to be a surge of people wanting to go on vacations. But just like as you're saying, I mean, I've got some friends of mine that are in the airline industry, and they say an airplane, if it's not at least 50% full, they lose money. Mm-hmm. And now flights, at least the ones that I've heard on, there's like 2 or 3 people on a flight. I mean, it's ridiculous. Yeah. They're hemorrhaging profusely. But even when this thing goes back to normal, can you imagine wanting to sit in a metal box with 50 to 200 people right next to each other like sardines?
Yeah.
It's going to take a while for that to go
100%. Away. I don't think people are going to really feel comfortable in certain, I mean, like I said, young people and people of that nature, they'll be fine. They really will. I think, spring break and summer times and all those things ain't going to keep college kids off planes, but it will 100% keep people like my parents from traveling and my grandparents from traveling, and we have to remember those people spend a lot of money, so I think that's where we're going to see it.
Okay. All right, guys. Well, Brian, is there anything else you wanted to talk? I appreciate your time. I don't want to, suck a lot more time. I didn't know how long this was going to go, but it's been a fun conversation. If you guys have any other questions, please post them below. And even if this, we end this thing right now, I'm sure either Brian or myself will get on there and answer those additional questions you guys have. But otherwise, I appreciate your time, Brian.
Of course, dude.
Have a successul weekend and have fun staying at home. And I guess we'll go from there.
All right, bud. Take care, man.
All right. All right. Bye-bye.